All right, so glad to be back here with you all. I'm going to keep the camera off of me for now because I'm still kind of recovering here, and you don't want to see a big slit across my throat where they did the surgery for me on Monday morning. So I'll kind of keep it on these slides. Needless to say, there's not really a whole lot going on in the markets here this week as of right now. Of course, things can change by the end of the week, but most likely we're heading into a summer season holiday weekend with not a whole lot going on to either one push us significantly to the downside below support, but also not enough there to give us a good bounce back to the upside. So just like we mentioned in the last video that I did last week, we're more than likely going to end up trading still in this range, but it doesn't mean that we can't make trades. So we're going to look at another example of a stock in the healthcare sector like we've done before, of a stock that's breaking out, and see if we can't trade that. So let's go ahead and get started. Today is Wednesday, May the 22nd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look, first of all, here at the S&P 500 using the Market Forecast Indicator. As you can see, we haven't closed back above the moving average yet and it's still declining. Let me get rid of these drawings for a second. Which means it's still red, but you notice the light green shading, which means we have a weak bullish posture. The intermediate line's rising, but again, it's when it gets above 50, that's when a new intermediate trend has started. So we're still kind of in this bearish mode. Last time I did this video, I mentioned we'll probably still trade in this area. I think that right there, this day was the day that I did the last Market Outlook video. And I kind of mentioned that I wasn't too bullish on that little bit of a breakout move and expected that we'd still come into this range, if not down closer to 2800, which is where all those support levels are. If not a little bit below that, to 2785-ish, to this old 1% pullback low. So that's kind of what we're seeing. If you look at this zigzag chart here, where is it? Styles. And you pull up, you can see that we've had some 1% pullbacks and bounces. So, here's our latest pullback, 4.5%. We did bounce in these 3 days over 1% higher, but that did form a lower green tag. And as of right now, we're forming a higher. We've had a 1% pullback to the downside. So, and that would be a higher low point, and that continues to be really the only. We haven't had a lower low point yet on these red tags, these 1% drawdowns. And this is our first peak. So it's kind of important to watch to see, okay, are we going to get back up above this peak, get closer to 2900 before pulling back down. And I actually think we're probably still, this 1% figure probably still has some room to go before we do bounce for another 1% move higher. So that's, nothing has changed in that regard since the last time that I spoke to you. We're still kind of muddling around inside of this retracement zone, this blue lines inside of that retracement. We never did get above it, which is what 2900 is. And that would be, most likely, that would be the beginning of our new bullish intermediate trend when we get back up above, 2900. But if we, keep pulling down, you see the small ranges, small volumes, weak bullish posture. The near-term line's not too bearish. You notice how it's not falling in the reversal zone. The momentum line is falling in the reversal zone, but it's not hitting extreme lows. And in fact, this would be a bullish near-term low point. It's a low in between 20 and 50 that, as of right now, is corresponding to a higher low on the chart, slightly higher. But a higher low on the chart. So while we might not be the most bullish right now, we're also not very strongly bearish either. Short-term sentiment's not giving us any indications that we are going to tank here, especially with all the support that we have. Let's take a look at some of these other. You can see the Dow looks almost exactly the same. The NASDAQ Composite a little bit more bearish. You can see we're back to a dark pink shading because the intermediate line did turn down. I have the red line, so that is a little bit more bearish than what we're seeing on the Dow. the extremes. And this is a higher beta name, so you are going to get more extremes in the momentum line. The near-term line, however, did not fall into the reversal zone yet. And then finally, on the Russell 2000, same thing: red line, dark pink shading, and bearish posture, but not, see, the probably more bearish in the short-term sentiment than what we see on the S&P. But you can also see we've been here before. So a breakdown below some of these lows, excuse me, would make us a lot more bearish than we are. And we're just not breaking below those low points yet. We're just basically pulling down to Fibonacci support areas, which would be around 1500 for the Russell 2000, where you'd have the equivalent pullback. All right, before we look at some other charts here, I wanted to remind you to subscribe to our YouTube channel. You can mouse over our Market Scholars logo over here and hit that red subscribe button. You can also see the same button here below the video. That will notify you when these videos are posted. You can also click the thumbs up icon. That lets us know that you like the video, number one. And number two, it tells us that you want us to do the video again tomorrow. So a quick way to give us feedback. And then finally, make sure you comment down below on anything that stood out to you from today's video. Also, be sure to sign up for our daily Market Outlook email list. So here's the blog post with our video in it. If you scroll down below the video, you can see this form that will sign, really quick and easy form, signs you up for our daily list that will give you watch lists as well as a timestamp summary of our video. You can also follow me on Twitter here for more content like this, like we do talk about here in between videos. There's my handle at DavidSettle42. You can also join our Market Outlook community that we've created as well for the Market Outlook. If you're on this page too, you can like today's Market Outlook tweet by clicking on that button. Opens up a new window, and you can click on like there once you logged in. Also, you can click on this image. It takes you to your Facebook page. You can like tonight's Market Outlook Facebook post. And then finally here, liking this in our community here on our website. And of course, you can share these by share the video by either of these buttons, whether on Facebook, Twitter, LinkedIn, or by email. Let's see if we can't. The goal is to get that number up to 100. We're kind of starting off with small numbers so far, but let's see if we can't get that number up to 100. All right, now let's go back to the charts. Let's take a look at the long-term chart. You can see very, very small range so far for the first 3 days of the week. Much smaller than what we've seen. From a Hakenyashi standpoint, we still don't have the upper shadow yet. We'd have to get above 28, was it 28.75? Right now we're trading at 28.56. So we got about 20 points to go to the upside. We'll probably end up getting, if we're going to get any more shadow on this candle, probably more of a lower shadow. You notice the bearish candles tend to have longer bullish or longer lower shadows and compared to the upper shadows in the bullish candles. So that's like a shadow, an upper shadow. So I wouldn't be surprised if we don't come down towards 2800 some more by the end of the week. Not that not the market's tanking. The markets will not be in turmoil if that happens, but it would produce a candle that we'd be more accustomed to. As I mentioned before, we'll probably get another week or two of bearish candles as we come down and test that 200-day moving average before we finally get a transition candle like this one with both an upper and lower shadow that we can now reverse on it and form a low point on. If you look at the 3 green arrows chart, you can see we still have we have 2 red arrows. We're below the falling moving average. The MACD is close to green arrow, and the stochastics has the phantom. So if you take a look at what that looks like on the 2-line version of the chart, the MACD is close to getting above its moving average. The stochastic already is above its moving average, but neither one of them are threatening the upper half of their charts, which again would signify that we're on a new bullish trend. So we're not there yet. In fact, we're still kind of trading around the 8-day exponential moving average to the downside, and the 17-day. We haven't really crossed up above that. Getting back above the 30-day would mean that we have that we've gotten above that 2900 level, which is the key level that would tell us we're back. We're back to a new 1 to 3 month intermediate run. All right, now let's take a look at the intraday chart, and you can see very small ranges the last couple of days. After gapping down on Monday after expiration, we got back up yesterday, and we've been in a really, really tight range, still in the lower half of the chart, and that's not going to change anytime soon. The low point and the high point are set for about another week here, so eventually that high point will start moving down, and the question is, are we going to move the low point down anymore? There's a possibility we could. Probably not that much more, but we are still in the lower half of the chart. The purple line is the Hakinyasha Open. You see we've been below that the whole week. So again, like I mentioned before, last Thursday, I thought, we still have some room to come down into this area. And I still think that's the case. I still think we'll get down into this area first before we get above this 290 area, which would be the 2900 equivalent on SPX. Let's take a look at the volume and the trading range for SPY today. And you see very, very small range. 1.5 points is all we had on SPY. So very small volume, 49 million shares trading hands. It's like a summer. We're hitting into the summer times again. Just to put those in the context here, you can see that the ATR was 1.5 points is way down here. It's bringing that line down. The volume is at 49 million. It's also going to bring that down. You can see the relative ATR has some room to go down too. So, it looks like we're not there yet on the new bullish trend, but we're also not bearish anymore either. So I don't expect this kind of bearish move, or definitely not this kind of bearish move, as we kind of bottom out here. And we're seeing that in these ranges and trading rooms. The downward moves are not piling on themselves. In fact, a lot of open candles during this pullback, which means we're closing above where we open more often than not. Whereas on the other hand, these filled in candles mean we close below where we open more often than not. And that's more bearish than this. So another good sign that while we may not be back on the train again, at least the train's not, blowing off the tracks here. It looks like we're setting up a good low point here that we can eventually bounce up off of. Let's take a look at the VIX chart, and you can see kind of hovering around some support here at the 90% mark. Remember, getting back below the 90% mark, and then eventually trading towards the 80% mark, like it did over here. That's when your bullish trend is re-engaged. So we're not quite there yet. So we were in the upper half of the bullish range, but never really threatened the 80% mark like we did. I expect that once we break 90, that's the type of range that we'll be trading in going forward. You can see we're still trading right around 15. So again, I wouldn't be surprised in the next week if we don't make another run up towards 17, 18, form a lower high point, and then continue to work our way back down below 15 towards the low double digits, and bringing this back, trading into both the upper half and the lower half of the bullish territory over here. Just to kind of show you how volatile things have been. We've had the 2% pullback here on that day. One of our, we've only had 2% pullbacks and then 2% bounce. But we did come close here to a 1% move higher. This was a 0.9% move higher after that 2% pullback. Right here we got a 0.1% move higher, 0.9, we got 0.92, and then here we got 0.90. So we got really close to 1% moves, but you notice no 1% moves to the downside. So it's, we had one there, we've had another one there, and had another one there. I mean, this range that we've been in, similar to 2017, it's crazy how non-volatile we've been, considering the headlines that appear to be so apocalyptic in terms of what's going to happen to the stock markets. The reality is there's just very, very little volatility here, and you notice the implied volatility in purple is about to close back below or drop down below the historical volatility. You can see when we have that happening, you typically get a good bounce coming out of that. In this case, we really got a good bounce coming out of there. So we'll see how much further. There's not a whole lot more for the for the implied volatility to go down. And historical volatility, which is what we've seen, versus the purple is what we expect to see going forward. The historical is not going to rise up anytime soon either, simply because we're not getting. You see how the light blue line rises when you get your 2% moves up and down, and your 1% moves up and down. See, we're just not into that mode right now for this. And if I were to give you some context on it, go back a little bit further, you can see here's that whole bullish, those two bullish intermediate rallies. You can see very few 1% or 2% moves. You can see the big bulk of them occurred here, and your light blue line rallied, and your purple line rallied ahead of it. So we're not rallying to the same levels that we did that previously moved the light blue line up. Same thing over here. We got this big surge, and it brought the light blue line up both times. And then once the purple line fell below the light blue line, that's when we had good low points develop. So whether we get that or not here, needless to say, we're not we're not getting this kind of pullback because we're not getting the same amount of 1% or 2% moves up or down here. It's been very, very light volume moves, light volatility moves. All right, so to summarize, the posture still is looking a little bearish, but not, the intermediate line is actually rising, so it's not as bearish as it could be. There's a lot of positive signs from volatility and how the candles are formed, and even if there might be still some more weakness for the next week or two, we might still trade in the lower half of the 4-week range. It doesn't appear that we're going to get a similar decline like we saw in the fall of last year heading into December. We're setting up a nice, good exhale that is more uncomfortable than people would like, simply because the rally was so big that preceded it. We're always fine with overextended rallies. We're not very fine with retracements, which that's the nature of the beast when you have a trending market, is to have impulse moves and pullback moves. And right now we're in the process of creating a nice, good, bullish pullback move here that we might be bouncing off of here sooner rather than later. So what do you think about that? Do you agree or disagree? There's a link popping out in the top right corner of your screen. Click on that link and then hit either agree or disagree on that poll. If you click disagree, for whatever reason, whether you're more bearish or more bullish, share what you're seeing that would lead you to that conclusion with other market scholars down in the comment section below. All right, now let's take a look at what's driving price action today. If you take a look here, and we'll just take a look at just today only. Here we go. Go to today. We'll go 10 minutes. You can see not a whole lot of movement. I mean, long-term bonds continue to rally with some weakness in stocks. Everything else, foreign bonds, high-yield bonds, preferred stocks, all of these are kind of very, very minimal moves. Even the S&P 500, the biggest outliers were small-cap stocks down almost 1%. And then crude oil, and like I said, bonds up at the top. Let's take a quick look at the chart for the 10-year note, the most common yield, the 10-year yield that's compared across the board. And you can see we're continuing to falter to the downside. If you take a look at the long-term view for TNX, we're continuing to get bearish candles from a Hakunashi standpoint. We did have a period of bullishness getting back to the 50-day moving average transition, but then that was really quick. A couple transition candles, and we're back to the downside now. So continuing to really trend lower on the 10-year note, and for that matter, if you look at the 30-year note, which is actually more correlated to TLT, you can see how bearish that is and how much lower it's going. And so, that's not the most bullish dollar environment here, but you can see that hasn't stopped the dollar from breaking out again, making another move up towards 98, and which is a very important level for the dollar index. Last time it failed to hold above 98. This time it looks like so far like it's holding pretty well. So we'll see if that ends up being the case. But you have falling, you have a falling moving average, you have a falling yield, and you still have rate cut odds right around 70% by the end of the year, and that dropped a little bit. Well, actually, that number actually came up a little bit. The odds of staying where we're at dropped a little bit here today on the FOMC numbers, as the odds of one cut stayed the same, but the odds of two cuts rallied, and the odds for three cuts rallied too. So, of course, we're not going to get three cuts. It's only a 5% chance that we'll get that many. But we got a 70% chance and a 77% chance of a rate cut by January of next year. So again, not the most bullish dollar environment, but it is a good environment for equities. It's nice for the markets to be focusing more, away from rate hikes and more towards rate cuts without actually getting the rate cut. Once you start to get the rate cut, then that's when you get, this scenario here, where these short-term yields start to really falter, right? And they'll start to come down, and the yield spread will rise. They'll start to come down as the market prices in the inevitability of a rate cut, and then really start to move down as the Fed does cut rates. But we're not to that point yet, and that's usually when you're closer to the market peaking. We're still not there, but we can be in this environment here where we kind of stick around. We have odds of rate cuts that we never get. We can be in that environment for a while, and as we've seen, that can be a really good bullish environment for equities, even if we do get some short-term weakness. Take a look at the calendar today. Not a whole lot. The FOMC minutes was the important thing, and the FOMC basically just stated that they're not, if you click on that link there, that they're not really worried about any moves up or down in the market. They're not worried about inflation, but they've got an eye towards trade, but they're not. Remember, trade is such a small amount of our GDP that it's not that big of a concern yet. In fact, you can see here most of these concerns or uncertainties, like as they quote there, are moderated. So not too concerned with the trade war like the rest of the markets are, especially the financial media. Oops, wrong one. So here, let's go here. So that's what we're seeing right now from a treasury perspective. Remember, crude oil was your biggest loser, your one big outlier to the downside. If you take a look at that, you can see we're back to being bearish on crude oil. Remember, economic growth uses these base materials to fuel that growth. And you got three red arrows and a red line on the market forecast chart for crude oil. You have dark pink shading with a red line. So we're kind of in a bearish mode for crude. And you break down below 60. If you go to let's go to the Bollinger Bands here. If you break down below this kind of 60 level, or maybe a 60, 81 or so, this 23% retracement, then you can see we have a lot of volume in this area, not nearly as much volume until you get towards this 52.5 area. Little bounces, small nodes here at 60 and 56 or so, but really not until you get down to about this 53.5, into this zone, which essentially is the lower end of the Fibonacci retracement zone. Once you get into that area, then you're going to find some support here. So it'll be interesting to see, if we do get that breakout, how much. Remember, crude oil's typically been pretty correlated with, has been pretty correlated with equities over the last little bit here. Let's change that to 63 with the SPX. And you can see very, very high correlations, 88% correlation. So if there's weakness in crude oil, most likely that's going to also correspond to more weakness in equity. So this is definitely an asset class we want to keep an eye on because of the impact it can have. if I were to kind of go back in time to see, it's not always strongly correlated. These are a continuous contract. That's why you're seeing some gaps here. But these aren't always continuously correlated with each other. If you look at crude oil, the USO, there are some times where it does dip below zero. And so this may be one of those situations where if the relative this correlation chart does come down again towards zero, that might be a situation where we get some weakness in crude, but not in equities, before they eventually do turn back around and head back up again. And considering the business cycle, we haven't really had that kind of big move in commodities, especially crude oil, which is typical of late business cycle moves. So I still think that type of move is still out there that we haven't achieved yet. And generally speaking, that will also coincide with a move higher in inflation expectations, which we're just not getting right now. You can see inflation expectations continuing to drop off a cliff, down back below 2%, and threatening this year's early low points. So again, that's typically not the most bullish dollar environment either. When we're in a deflationary mode, the benefit of the dollar that it's getting is that it is, most everything is falling against it, especially the pound and the Aussie and Kiwi. I mean, those currencies, and you can see the Canadian dollar, big trading partner, and even the euro to a small extent, they're all kind of showing weakness against the dollar, and that's what's driving the dollar strength, is the weakness in some of these other markets. In fact, if you take a look at like the pound US dollar, and look at the clusters we've been getting on the pound, and that's on a daily chart. If you look at the weekly chart, we now have that bearish pattern of dark pink shading and a red line. That can be pretty darn bearish. If you look at Euro US dollar, oops, I need to put that in there. Same thing, dark pink shading, red line, even if it's getting a cluster. And then finally, like the Aussie US dollar, dark pink shading, red line. We're continuing to move lower. Remember, this is on a weekly chart, and we're getting really close to producing a monthly chart. And you can see how the monthly chart's looking for the Aussie, still below a falling moving average there. And you look at the euro on the monthly chart, dark pink shading, and its moving average. It looks like it's close to being rolling over to the downside. And of course, the pound US dollar, dark pink shading again, and we'll see if that ends up turning down here. Let's get rid of this. Looks like I've got two of them there. So it remains to be seen if we will get this line falling down. Right now it's going up, and it will take a month, right? This is a monthly chart, so it takes a lot longer, but not the most bullish of patterns on these other currencies. And right now, that's what's providing a good lift to the greenback. If you take a look at the impact that that's having, you can see there are some emerging markets that are doing pretty well today. Russia is doing well, and Poland, Thailand. On the other end of the spectrum, you have some, Turkey, Indonesia not doing as well, right down there with the small cap index. But I mean, you look at some of these major economies that look so much more bearish than what we're seeing on the dollar. Germany is holding up well. France is holding up well. India has really bounced up in the last couple of days from really oversold levels that we're not seeing the same bounce higher in China or in Korea. And of course, you can see Russia taking off to the upside, and Brazil bouncing off of its oversold cluster. So, there are some areas of the markets that are a lot more bearish than what we're seeing in the U.S. But the U.S. isn't the most bullish either. As you can see, India is closer, already has crossed above 50, even though we don't have the green line yet. It's crossed above 50. Russia has crossed above 50. So if you look at it, it's got the intermediate line turning up above 50 and a green line in the moving average. So that's a good sign, a good move for Russia, that we might be trending on that index again. Canada is getting close to crossing up above 50. So some are doing well, some of them just aren't. Korea is so far down. China is so far down below 20. Those are the ones that are more impacted, obviously, by these trade headlines. When we take a look at the sector performance, you can see the biggest movers today were utilities, real estate staples, healthcare, so all safe havens, all outperforming the S&P 500. On the other end of the spectrum, energy, materials, and industrials, dollar-sensitive areas, all falling the most. And then you also have your cyclicals, technology, consumer discretionary. You can see what their charts look like. Healthcare, utilities, real estate, staples, they all have the better looking charts. Whereas look at discretionaries rolling over with a falling moving average, and industrials rolling over, dark red, dark pink shading with a red line, dark pink shading on technology with a red line, dark pink shading with discretionary with a red line. So energy, dark pink shading below 50 and falling on the intermediate line with a red line. And then materials, it doesn't have the dark, it has light green shading because we are rising, but still, not too bullish here. So some of these areas look bullish. Utilities, real estate, staples continue to look bullish. As always, I show you this chart, and you can see over the last 200 days, the better returns continue to be in staples, utilities, and real estate. You're starting to get some pickup here, and you can see if I zoom out, to about, this is 2017, so let's go over here to the beginning of this year. So here's October of 18. You can see how these really underperformed, and we had some good performance in these cyclical areas heading into October the 3rd. Right there, that was the last time, that's when the market peaked. Well, since then, these staples, healthcare, utility, you see real estate picking up over there on the right. So that's typical of a safe haven move. This is the 26th when we hit the low point. Since then, you can see cyclical areas picking up some moves, pulling back on these safe haven areas, but they're still showing some strong gains, and that still means that we have good bullish potential heading forward from here, considering that we have very low returns in these more cyclical areas, very, very low returns in the dollar sensitive areas. So eventually, that's another reason why I actually expect the dollar to be weaker, because I expect these to bounce up higher along with industrials. And then, of course, these would start pulling back in that environment and move down towards the downside. All right, for our trade idea of the day, I want to take a look at this healthcare sector that's been slowly improving. It had been such a laggard for so long. It's been starting to show some outperformance, actually, relative. In fact, if you look at the last couple of weeks here, which is what this column is showing us, it's right up there with the other safe haven areas where it had been, the big negative, the big loser here for a while. Anthem, you see how yesterday we had a nice little breakout pattern, and not only did we break out above kind of all these highs, but it also broke above a really strong volume resistance to the point now where there's not a whole lot of volume up above where we're at right now. So there's an opportunity for a bullish trade in the sector that's showing some improvement. And you can see not all stocks are as bullish. In fact, we did a stock on a trade on Humana, and that's been turning around here. And in a previous market outlook video, you can see after that engulfing pattern, kind of double bottom low, you can see it's been bouncing up. So here's another opportunity with this breakout move. You don't have the rising moving average yet, so it's not as bullish as it can be. And you can see the same thing with the three green arrows here. We don't have that moving. We do have three green arrows, but we don't have that line moving up. If you take a look at the two-line versions of these green arrows, you can see the 8 and the 17 have both crossed up above the 30, and we're above all. They're all, the 8 and 17 are both rising. The MACD is above 0, stochastics is above 50. So you are getting a pretty decent pattern. The Bollinger Bands, you can see, are breaking up above the upper band with the bandwidth able to rise. And then finally, you look at the DMI here, and you can see, it was so bearish that bearish line now has fallen below 20, and the positive line is crossed above 25. So a good DMI pattern there too. Finally, let's take a look at the long-term view of Anthem. And you can see, this week now, this breakout's getting us back up above the 200-day moving average and the 50 for that matter, with the MACD of those two stalling out here at 0. So a pretty good sign and pattern to be able to trade that. And again, we don't want to be aggressively bullish because the market's not there yet, hasn't bounced yet. But if I were to sell the 270 put and then buy the 265 for protection, it gives me decent probabilities of success here and trying to get around that. $1.16 is what we need to get. So expensive stocks, you have to fiddle around with the pricing. But that's kind of return. Again, I'd be willing, if I got that $1.25, that's how much I'd be willing to lose, is 125. That's down in this area over here, at least on the purple line. So in other words, we'd have to break back down for us to achieve that level. We'd have to break back down below where we opened yesterday. So essentially to nullify that breakout for us to take the $125 loss. So nice little setup here for a high probability trade in a sector that has been so beaten up that is showing some signs of life across multiple stocks here. All right, as always, that wraps us up for today. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen to go to our forums on marketscholars.com, specifically our Market Outlook forum. Post any new thread, reply to any other threads with any questions or comments that you have from tonight's video and anything we discussed or anything that we didn't discuss that pertains to what we go over in these videos. So, as always, thank you very much for watching. Have a great rest of your evening. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content, and also join our community on Facebook. Have a great one, everybody, and we'll see you all tomorrow.